right, ready to decode the market. Today, we're going to deep dive into Elliott Wave theory. We're cracking open Elliott Wave Principle, key to market behavior. It's by Frost and Prechter. It's a classic. Claims to kind of, reveal patterns in the market.
Oh, yeah, fascinating theory, really. It tries to connect market psychology, right, with these recurring patterns using the Fibonacci sequence. We'll break it down, though, don't worry.
That's right. So whether you're, prepping for a market analysis presentation or just fascinated by these patterns, this deep dive is for you. Let's start with the basics, the five-wave pattern.
Okay, so the Elliott Wave Principle, it suggests that market trends, they unfold in 5 waves. It's like, think of a wave crashing on the shore. It has peaks and troughs. 3 of these waves, we label them 1, 3, and 5. Those are impulse waves, like powerful surges of water, pushing the trend forward.
The main driver is the one setting the direction. What about the other two?
The other 2, those are waves 2 and 4. They're the corrective waves. That's where the wave kind of recedes, like a pullback against the main trend. It's like the market taking a breather. You can see this visually in the book, figures 1-1 and 1-2.
Okay, yeah. Starting to see how this could be helpful. So we have this 5-wave pattern, but obviously the market doesn't stop there.
Yeah, you're right. Yeah. The 5-wave pattern, just one piece of the puzzle. Elliott wave theory, it proposes that these patterns, they repeat at different scales. So it creates this fractal-like structure. It's like zooming in and out on like a coastline. You see those similar patterns at different levels.
At a fractal element, so cool. But with all these waves within waves, how do we even analyze this? It seems, pretty complicated.
Right. Well, that's where wave degree comes in. Helps classify waves, by size, position within the overall market structure. It's like, think of it like a family tree, but for market waves. The grandparent wave, the parent wave, child wave, and so on.
All about understanding the hierarchy, the relationships between these waves at different scales.
Exactly. And each wave, it has a function too. It's either driving the trend forward, what we call action, or correcting the trend, we call that reaction. This interplay, the action and reaction, that's what creates that ebb and flow of the market, at least according to Elliott wave theory.
It's like a dance between these opposing forces, always pushing, pulling. You mentioned wave extensions and diagonals earlier. Those sound kind of cool.
No, they are. So wave extensions, that's when you have an impulse wave, like wave 1, 3, or 5, and it just goes on a really long run. Creates a longer sequence than usual. It's like, imagine a sprinter suddenly deciding to win a marathon.
I can see how that would shake things up. Now, what about these diagonals?
Diagonals, okay, they're really interesting. One of the most powerful patterns in Elliott wave theory, actually. 5-wave structures. See, they're not like those typical 3-wave impulse waves. And they appear at really specific points in the market cycle, so they give us clues about what's going on underneath.
Dramatic moments, hinting at big shifts.
Precisely. And there are 2 main types, ending diagonals and leading diagonals. So ending diagonals, they usually pop up in the 5th wave position of an impulse wave, or in wave A of a zigzag. It's like a final burst of energy before it reverses. There's a good example in the book, an ending diagonal in the Dow Jones Industrial Average, figure 118.
So that's a sign that things are about to change. Be cautious. What about leading diagonals?
Leading diagonals, those show up at the beginning of a trend, either in wave 1 of an impulse wave or in wave A of a zigzag. Think of them as that initial burst of energy propelling the market forward. They can be a little tricky to spot, though, as they're forming. The book gives a good real-world example. Figure 120 makes it much clearer.
So much to unpack. And we haven't even gotten to corrective waves yet. Before we jump into those, could you just recap the diagonals real quick?
Sure. Okay, so diagonals, they're 5-wave structures. They signal acceleration or deceleration in the trend. Ending diagonals, that suggests exhaustion, often before a reversal. Leading diagonals, they signal a strong thrust at the beginning of a new trend.
Great recap. What fascinates you about diagonals?
It's their predictive power, really. They show up at such specific points. You can really kind of anticipate those turning points, like flashing neon signs. Pay attention, something big is happening.
I love that. Okay, now we're ready to tackle those corrective waves. We know they move against the main trend, but what makes them, unique? How can we differentiate between them?
That's a great question. Corrective waves they're fascinating because they add that complexity,
Mm.
to the market's rhythm. They're not straightforward like the impulse waves with their five-wave structure. Corrective waves, they come in different flavors, like zigzags, flats, and triangles. Each one has its own personality. It provides clues about what's really driving things.
Okay, I'm all ears. Let's start with zigzags. What makes them stand out?
Zigzags. They're like the quick pullbacks,
Yeah.
sharp. They have this distinct three-wave structure. We label them ABC, with waves A and C moving with the correction, and wave B, that's a counter trend move, like a quick breath before the market keeps going. The book shows some simple zigzags, figures 122 and 123.
So a brief pause before the market gathers momentum. But the book also shows a more complex zigzag. In figure 126, it's labeled a double zigzag. What's going on there?
Ah, good eye. Sometimes those corrective waves, they get a little more elaborate. A double zigzag, it's just two zigzags, right? They're joined by this connecting wave, which is usually labeled X, adds layers to the movements. Figure 127, that has a real-world example of a double zigzag in the Dow Jones Industrial Average.
It's like these patterns that can nest within each other, creating even more intricate movement. So we have these sharp, quick zigzags. What about flats? Do they live up to their name?
They're different. They're more like a sideways drift, a period of consolidation, indecision, maybe. They still have that three-wave structure, though, ABC. But waves A and B, they tend to be more equal in length, so it looks flatter, more horizontal.
A timeout for the market to, catch its breath,
Yeah.
decide its next move. The book shows some basic flats in figures 131 and 132, but then there are these expanded flats in figures 133 through 136. What makes them expanded?
Expanded flats. Interesting because wave B of the correction, it actually goes beyond the start of wave A. It's like the market taking a little detour.
Yeah.
And just like zigzags, flats can also be inverted. See figure 137. Wave C ends much higher than wave A.
Wow, so many variations. It's a whole new language.
Yeah.
Okay, so we've covered zigzags and flats. What about triangles? What do they tell us?
Triangles, okay, they're like the calm before the storm. They suggest this balance of forces in the market, a period of tension. Before a breakout or breakdown, they're five-wave patterns, A, D, C, D, E, characterized by contracting price swings, creating that triangle on the chart.
The market is winding up, building energy. The book describes um, contracting triangles, barrier triangles, and expanding triangles in figures 142 and 143. Are those the main types?
Yeah. So contracting triangles, those are the most common. Each wave gets smaller. Then you have barrier triangles. They stay within a certain price range defined by a previous high or low. And expanding triangles, well, they do the opposite. They expand outwards. Each wave gets bigger.
Okay, starting to see how understanding these patterns
Mm-hmm.
could help us anticipate those big market swings.
Exactly. And here's a really interesting example from the book. Figure 144, it shows this nine-wave triangle in the silver market, formed between 1973 and 1977. It's pretty rare and complex, but it shows how nuanced these corrective waves can get.
A nine-wave triangle in silver. Incredible. It really shows how these patterns, they can reflect that market psychology.
Precisely. It's not just lines on a chart, right? It's about understanding the emotions, the behaviors driving those market trends.
This deep dive it's giving me a whole new perspective, really. So we've covered so much.
Okay.
The five-wave pattern, wave extensions, diagonals, all those different corrective waves. What stands out to you about corrective waves? Why are they so important?
Well, corrective waves, what's fascinating is they provide those clues,
Yeah.
about the strength of a trend, the maturity. They can be tough to analyze, though.
Yeah.
Because of all the variations, but that's what makes them so rewarding. By mastering those corrective waves, you can gain a deeper understanding of market psychology.
It's like they're the key to unlocking, like a deeper level of understanding. Okay, ready to dive into those guidelines and rules, but we'll save that for part 2.
Welcome back. So we just finished exploring those corrective waves, zigzags, flats, triangles, the moments where the market, it kind of takes a breather before resuming the trend.
They're like the twists and turns, make the market so unpredictable, but also so captivating. So now let's get into those guidelines and rules, the ones that help us make sense of all these Elliott wave patterns.
Yeah, it's like we've learned the alphabet, of market movements, and now we're trying to put those letters together, form words and sentences. understand the market's language.
I like that.
No.
So, what are some of those grammar rules then? The ones that help us decode these patterns?
All right. Well, one of the key guidelines is alternation. It suggests that corrective waves they alternate in form. Like, for example, right? If wave 2 is a zigzag, sharp and deep, then wave 4 is more likely to be a flat correction, or vice versa. Like the market likes to keep us on our toes.
So it's not just about identifying the pattern itself, but also about understanding the context. Like how one wave influences the next.
Exactly. The book gives some visuals for this alternation principle, figures 2.2 and 2.3. Okay, another guideline. This one's about the depth of corrective waves. The depth, that refers to how much a corrective wave retraces the previous impulse wave.
So like if an impulse wave pushes the market up, say 100 points, how far back could we expect a corrective wave to pull it down?
Good question. So a general guideline, fourth waves, they typically don't retrace beyond the end of wave 1. So in your example, wave 4 shouldn't retrace more than those 100 points. It helps you identify potentially incorrect wave counts. Avoid those common pitfalls.
So wave 4 shouldn't like completely undo the progress made by wave 1. Makes sense. What about channeling? I've heard that term used a lot.
Right, channeling. Channeling is one of the most useful guidelines, really reliable in Elliott wave analysis. It suggests that impulse waves, they develop within channels. Think of them like boundaries, pathways for the price action. So these channels, they're formed by, drawing lines, parallel lines, connecting the ends of waves 1 and 3, and then you project those lines, try to anticipate where wave 5 might end.
Like drawing those trend lines on a chart, trying to capture the flow.
Precisely. Figures 2.8 and 2.9 in the book, those they visually illustrate those channels. Now, related to channeling, there's this concept of throwover. That happens when wave 5 it breaks out of the channel, often with a surge in volume, so it signals an acceleration in the trend.
The market breaking free.
Yeah.
Hinting at like a really powerful move.
Exactly. Figure 2.10, that gives you a good visual of a throwover. And then there's the right look guideline. This one's a bit more subjective, but it's so important.
Subjective. So we have to rely on like intuition.
Well, not entirely, but it does involve judgment. The right look, it just means that a wave count, it should make sense visually and conceptually. It shouldn't feel forced, The book emphasizes this point, figure 213. It shows how a wave count could look technically correct, but it doesn't really, it doesn't fit the bigger picture.
It's about combining that technical analysis with a sense of the market, the context, and maybe a little bit of intuition.
Exactly. So we've covered some guidelines, right? Those principles to help us interpret the Elliott wave patterns. But Elliott wave theory, it also has rules, hard and fast rules that you really need to understand.
Okay, let's hear those rules. What's rule number 1?
Rule number 1: wave 2, it never retraces beyond the start of wave 1. This is like fundamental to defining the structure of an impulse wave.
So wave 2 can't erase what wave 1 did. Got it. Rule number 2.
Rule number 2 says wave 3, it can never be the shortest wave. In an impulse wave, that is. It shows how important wave 3 is, as the most powerful part of the trend.
So wave 3 should always be longer than wave 1 or wave 5. Makes sense. Is there a rule about wave 4?
Yes. Rule number 3, it says that wave 4 can never move beyond the end of wave 1. So this keeps the integrity of the overall impulse wave structure.
Wave 4 has boundaries. It can't overlap with wave 1. Is there a fourth rule?
Yeah, the fourth rule, it's specific to diagonals. Wave 4 always ends within the price territory of wave 1 in a diagonal. So this helps distinguish diagonals from other 5-wave structures.
Okay, got it. So those are the 4 main rules. They seem simple enough, but I imagine they have big implications for how we analyze the market.
You're right. These rules and the guidelines we talked about earlier, they give you this framework, right, for understanding and anticipating market behavior.
It's like we're learning the code to unlock those secrets. Before we get to that Fibonacci connection, what's the key takeaway here about these rules and guidelines?
The most important thing to remember is that these rules and guidelines, they're not just arbitrary. They come from decades of observation, analysis of market data. So by understanding them, applying them, we tap into a powerful system.
It's not just following blindly. It's about understanding the logic, the reasoning behind these principles.
Exactly. It's about developing awareness, a way of seeing the market through the lens of Elliott Wave theory.
Okay, I'm ready for that Fibonacci connection,
Yeah.
but we'll save that for part 3. All right, welcome back to the final part of our Elliott Wave deep dive. So we've gone over, the 5-wave pattern. We talked about diagonals, corrective waves, all those guidelines and rules. Now it's time for the grand finale, that mind-blowing connection between Elliott waves and the Fibonacci sequence.
This is where things get really interesting. Elliott wave theory, it goes beyond just the charts. We're talking natural laws, mathematical harmony.
I'm intrigued. Let's do a quick recap of that Fibonacci sequence. What's so special about it?
The Fibonacci sequence, it's a series of numbers. Each number, right, it's the sum of the two before it. So it starts 0 and 1, then it goes 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, and on and on.
Right. I remember that from, school. But I never knew it was so important.
It's everywhere. In nature, I mean, you see it in like sunflower seeds, how they're arranged, the branching of trees, the nautilus shell, even the human body. The book, it actually has some visuals in chapter 3, figures 3 through 3 to 9. Amazing.
Like this hidden code underlying, like the structure of everything. But how does it connect to the market?
That's what's so cool. Turns out the ratios from that sequence, especially the golden ratio, they pop up all the time in those market price swings. The golden ratio, we represent it with the Greek letter phi. It's about 1.618, or the inverse, 0.618.
So the golden ratio, the one we see in like art and the human body, it's also reflected in how markets move.
Exactly. And the book, it really goes deep into this in chapter 4, explaining how those analysts, they use Fibonacci ratios to identify those support and resistance levels, forecast price targets, figure out those turning points.
I can see how that would be useful, yeah. Can you give like a specific example of how we apply these Fibonacci ratios?
Sure. One common way is retracement levels. A retracement, so that's like a pullback or correction during a trend. One popular retracement level, it's 61.8%, the inverse of the golden ratio, meaning after a price move, the market, it often retraces about 61.8% of that move before it, keeps going in the same direction.
So if a stock goes up, let's say 100 points, we could expect it to pull back around 61.8 points before going back up.
That's the idea. The book has some great examples in figures 4.1 and 4.2. And it's not just retracements. We also use Fibonacci ratios to forecast price targets for those impulse waves. I mean, wave 3, it's often 1.618 times the length of wave 1. So you can use that relationship to project targets. Figure 4.4 illustrates this.
So if you understand those ratios and how they relate to Elliott waves, you can anticipate how far those market moves will go.
Precisely. And the book, it even has real world examples of how this works. Like this guy, Robert Rea, back in 1964, he used Elliott wave theory and those Fibonacci ratios, right, to predict a turning point in the stock market. It's on page 141. And he was right. It shows how powerful these two things are together.
Wow, that's pretty amazing. It's not just a theory then. It's like a tool you can use. Are there any other ways we use those Fibonacci numbers in Elliott wave theory?
Yeah. The book talks about Fibonacci time sequences. The idea is that those big market turns, they happen around Fibonacci numbers of days, weeks, months, even years. There are examples on page 148. And figure 418 shows this Benner Fibonacci cycle chart. It illustrates those long-term cycles in the stock market, all based on Fibonacci time periods.
So those Fibonacci relationships, they apply to both like the price and the time.
Exactly. It's about seeing the patterns, those echoes of, natural laws and how markets move.
This has been really incredible. We started with, the basics of Elliott wave theory. Now we're talking about Fibonacci ratios and the golden ratio.
Right.
Before we wrap up, what's the most important thing you want listeners to remember?
The main takeaway, I'd say markets might seem random, right? Chaotic. But underneath, there's this order, a rhythm, a structure. And it reflects natural laws, human psychology too. Elliott wave theory with Fibonacci analysis, it gives us this framework to understand these patterns and maybe even use them to predict what's going to happen. It's not about knowing the future, but it's about seeing the market in a new way.
It's about moving from randomness to order. Feeling, empowered. This deep dive, it's really opened my eyes to a whole new way of looking at things. And we've only just scratched the surface, right?
Absolutely. There's so much more out there to learn, to explore. Maybe you'll even start to wonder if those market patterns, if they really reflect natural laws, does that mean, the future is predictable? at least to some degree.
What a thought-provoking question. This deep dive, well, it's given us the tools we need to figure that out. Thanks for joining us on this fascinating journey into Elliott wave theory.